Good afternoon, and welcome to Will Your Bank Emerge Stronger When the Liquidity Surge Recedes? Today we hear from industry experts as they provide critical advice for how banks can thrive despite a challenging environment. Discussion topics will include alternative lending strategies, risk management, and core deposit insights. We thank you for joining us. I'm Naomi Snyder, the Editor-in-Chief at Bank Director. I'm in charge of our quarterly magazine, the editorial content on our website, and in our free weekly newsletter, The Slant. This webinar is brought to you by both Bank Director and IntraFi Network. An information resource to the financial community since 1991, Bank Director focuses on the strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. Promontory Interfinancial Network is now IntraFi Network, the trusted partner to nearly 3,000 financial institutions. Their solutions can help your bank attract and maintain valuable customer relationships, grow reciprocal deposits, diversify funding, and reduce collateralization, improving liquidity and returns. Before we get started, let me just share a few things to keep in mind. First off, don't worry, we can't hear you. You have joined this webinar in listen-only mode. We recommend that you click on the slide bar at the bottom of the screen to adjust between the presenters and the presentation. If you have questions for our speakers, please note them by clicking the Q&A button found on the right side of your screen. You can do this at any time during the presentation. Once our presenters have finished with their talking points, we'll have a Q&A period where those questions will be addressed. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email. It will also be available on bankdirector.com. If you have any technical issues, you may also note those using the moderator chat feature on the right-hand side of your screen, and we'll do our best to take care of it. Finally, the opinions expressed in this webinar are those of the individual speaker only and do not necessarily reflect the opinions of the other speakers or of the entities with which the speakers are associated. On that note, let me share a little bit about our speakers today. Danny Capital is the Managing Director at IntraFi Network. You remember this from its former name, Promontory. He is responsible for growing and managing a portfolio of network banks within the region that utilize the company's suite of balance sheet management solutions. He has been instrumental in growing the company to be the largest deposit placement service provider in the country, with 3,000 financial institutions in its network. Frank Ferrone is the Managing Director at Darling Consulting. Mr. Ferrone consults nationwide with CEOs and CFOs of financial institutions to increase earnings through the proactive management of capital, liquidity funding risk, and interest rate risk. He is a frequent speaker and author on topics such as industry issues and trends, funding solutions, regulatory issues, interest rate risk management, capital management, and others. Steve Kinner is Senior Managing Director at IntraFi Network. Mr. Kinner has more than 27 years of banking industry experience. Formerly, Kinner was Senior Vice President of Sales and Marketing at the Federal Home Loan Bank of Des Moines. So, saying that, Steve, Danny, and Frank, please take it away.
Thank you, Naomi. Danny's going to share his screen for us, everyone, and we'll get started. As Naomi said, the question today is, will your bank emerge stronger when the liquidity crisis or surge recedes, as crisis recedes? And we're here today to share some strategies with you. But before we do, on the next slide, Danny, I just want to say thank you. I'm always humbled. I was a community banker early in my career, humbled to be with you and to say thank you to you for leading us through this financial crisis, this COVID crisis that resulted in a lot of financial crisis. This incredible situation you guys are finding yourselves in as bankers, and certainly, but from Frank and myself and Danny, that we're all here to help you navigate those waters, if you will. Today's agenda, a little introduction from me. We're going to talk about current market conditions and what you're facing today, and then opportunities for your bank. We're going to really dig into some concrete opportunities that we see banks deploying today within each of their environments. A little bit more about IntraFi. You heard a lot from Naomi just a moment ago. We were formed in 2002. We invented the reciprocal deposit, right? That is our invention. We bring scale to you. We bring synthetic size to your banks, allowing you to take advantage of being a part of a network with some 3,000 other banks, which represents about 50% of all U.S. banks. But if you just look at banks $1 billion in assets and above, we're well over 80% of those banks use our services across the country. We're endorsed by the American Bankers Association. We're also a preferred service provider of the ICBA. And a little bit more about Darling. Known Frank a very, very long time, and Darling Consulting Group is certainly a leader in their space with all the modeling and consulting and ALM work that was mentioned a moment ago. They work with over 600 financial institutions nationwide and most of the top 100 in the country. So you get an opportunity. If you're not working with Darling, you have an opportunity. At the very end of the screen, Frank's contact information is there. We'd love for you to get a hold of him. Let's talk about current market conditions. We're all besieged by all these headlines, right? Banking industry is at a crossroads for sure. Top left-hand corner, U.S. bank margins continue to take a beating. Let's go to the top right. We'll talk about this more in a moment. Loan to deposit ratios drop even further, reaching a new record low. Mid-tier banks are gaining deposits, share back from money center rivals. Not sure we want all that, but there's customer opportunity tied to that. There's a case in the center in the bottom of this screen, a case to build deposits in a market flush with cash, right? So we're going to talk about core deposits. Banks moving to the right says banks say deposit glut is a new normal. Now what? Think of everything else that we're facing. The administration now is trying to get us to become IRS reporters. The SBA is trying to start doing direct lending. The post office has piloted four cash checking operations around the country because they want to get into banking services. You're dealing with new kinds of balance sheets we've not seen in the past. Banks are, we're shuttering branches. Hey, my 94-year-old father can now pay his bills online for the first time in his life because of COVID and this crisis and things that we've come through. So there certainly are a lot of changes and a lot of opportunities also come along with those changes. So a little bit about when the lending environment will improve. We're certainly seeing green shoots. We've seen pockets, at least from our perspective. Interesting to get Frank's in a moment around the country. There are banks finding some lending opportunities, but this chart represents the loan to deposit ratio each quarter. And 51 of the all-time lowest 52 loan to deposit ratio observations happened in the last 52 quarters, rather. 51 happened in the last 52 quarters. Obviously, it's extremely low. We did see at the end of last quarter that deposit inflows slowed quite a bit. In fact, just a hair above lending growth. So we may be had some interesting information when the September data comes out. We maybe it's an equilibrium, but we certainly think that if we're not at rock bottom, maybe we're close and it's time to start crawling our way back out of this situation. At IntraFi, we do a quarterly survey. We call it the Bank Executive Business Outlook Survey. And we survey thousands, just an awful lot of bankers respond to this around the country, guys. And they tell us what they think, right? So this is that perspective of what your peers are thinking around the country. And a full 2/3, now this is pre-Fed announcement a couple of weeks ago, full 2/3 expected to return to some recovery level in 2022, which we thought was very encouraging. So we think there's some good news. Obviously, there's a distribution, as you can see on the screen, by geographical region. The Northeast always tends to come out a little bit better than everybody else. And I think this just has to do with their economy. Tends to always sort of be ahead of the rest. But you can see that there's a lot of optimism, I think, for 2022. And certainly the Fed announcement recently will tie into that. On the next slide, Danny, Frank, with the Fed telling us, okay, we think the dot plot, we think things are going up. Talk to us, Frank. What's the Fed doing?
Dot plots. I mean, what you find is when you look at these historically is they're never right, they're always wrong, and oftentimes they're way off. So I wouldn't put any credence in any of the dot plots. The important thing here, where it talks about the dots keep moving higher, where the expectation was that we were going to be down here for longer, lower for longer. All of a sudden now there's more optimism. And so all of a sudden now the expectations, if you look at the midpoints, of where the expectation is for the Fed funds rate to be at the end of the year for 2021 through 2024. One of the things you notice is once we get into 2022, there are some that think that, we're going to hike rates. Not all of them, but some of them. If you go into 2023, there's an increased or an elevated number of governors that think the Fed funds rate should be closer to 1% at the end of 2023. And then longer term into 2024, somewhere around 2%. Right? And again, that's the midpoint. What's interesting is if you look at these dots and you look at where those dots fall on the chart, some are still relatively low and some are right. So that's the midpoint. And again, don't use this as gospel. And one of the things that I think is problematic for a lot of banks today is they're sitting on so much cash. Their earnings are under pressure, and they look at some of these graphs, and there's a tendency to have a bias against higher rates, and so they sit and they wait and they hope that rates go higher. That's not a bet that I would make. So when we talk about the dot plot and where rates are going, it doesn't matter. Rising rates is our friend, and every institution that was concerned about rising rates 2 years ago, now recognize, be careful what you wish for. If we go to the next slide, one of the things that I reminded a client of this morning was, if you look back when in 2008, 2009, when the curve was flat, Fed funds was 5.25, margins were about, reached their height. Number one. Number two, stock prices were much higher in the banking industry. And so, again, higher rates is beneficial to the community. One of the things that a lot of banks were concerned, and even the regulators were concerned, see that little box in the upper right there is, when you looked at loan to deposit ratios, if you go back to 2018, going into 2019, where kind of the blue and the light blue meet, regulators were concerned that, there's an impending liquidity crisis. If you looked at the level of cash on balance sheets back then, it was very low because everybody was making loans. The economy was strong. There were high levels of borrowings. We had clients that had 40 to 45% of their balance sheet wholesale funded. And I can tell you that many of these same institutions got the best rating you can get, right, from an overall rating perspective. And yet some of us are so concerned about having that loan to deposit ratio creeping up to certain levels. So if you go to the next slide and we talk about the impending liquidity crisis, this is a time, if you notice where I boxed it out at the top, this is just like a board report, an executive summary that we use for our clients. And I highlighted at the upper right-hand section here some of their liquidity metrics. And one of the things you notice, and this is very important, look at the borrowings to assets policy, 45%. Look at the broker deposits to assets policy, 15%. Total wholesale funds to assets, 50%. So think about that. Do your policies really give you the amount of flexibility to manage through some of these environments where loans are strong, liquidity is a little bit more challenged? Because at the end of the day, we're going to end up going back to where we came from. And to the degree that you're better prepared and you've got all your ducks in a row and you have access to all these alternative funding sources, as well as policies that give you the maximum flexibility to do what's in the best interest of the balance sheet, which is really what this is all about, giving you all the tools at your disposal, the better prepared you're going to be. If you go to the next slide, and I take this same institution, there's a lot of numbers on this page. The most important thing I want you to focus on this page is, number one, this is a relatively decent sized institution, a little bit over $1 billion, right? They had $8 million in Fed funds overnight sold. Their liquidity position on balance sheet was a little over 3%. If you look at that green box down at the bottom left of the page, this is what we call our basic surplus approach. It shows you on one page all the available access to funding that this institution has, which gives you the intestinal fortitude not to have to pay up for deposits unnecessarily, or go to the least cost funds of margin, not have a lot of cash sitting on the balance sheet, burning a hole in your pocket like we're seeing today. So if I look at the on-balance sheet liquidity that I have, access to the Federal Home Loan Bank, access to the broker market, we've got 30%, even when we assume a 5% runoff of deposits over the next month. That's a lot of liquidity. You look to the right side of the page, I boxed it out in blue, and you can see we've got notes in there, and the last one being, current broker deposit balances do not include reciprocal now ICS deposits or reciprocal CDs. I would say that the majority and almost all of our clients use and have access reciprocal deposits through Promontory, now IntraFi. It has been an invaluable tool to have, as you know, and yet I still see a lot of institutions that don't have access to this, or policies that are too restrictive. If you go to the next slide, again, revisit your policies. The liquidity crisis is here. It's just not the one we expected. 2020 hit, and then you got to build that slide, and all of a sudden, bang, COVID hit, and now we've got the greatest level of liquidity surge in banking history. And more often than not, the majority of the phone calls that we get today is, we got too much money, we don't know what to do with it. What do we do with all of this excess liquidity? Well, it begs the question, how much of this is excess liquidity? You have to define that, number one. Number two, to the degree that you have, just like I showed you on the last page, access to all these alternative funding sources, why do I want to keep all this excess cash on balance sheet when I know I can put it out on the curve, which is going to help my margin, it's going to help my return on assets or my return on equity. I don't need to keep all this liquidity hanging around. From an interest rate risk management, we know that a low rate environment is not healthy for the banking industry. And while some of us may have worried about rising rates in the past, and some of us are still worried about rising rates, right? The reality is rising rates is our friend. Capital management. Right now we've got so much excess liquidity putting capital pressure on our capital. The question becomes, what do we do? So this all comes back to, let's talk about deposits. Most of us are worried about how long is this money going to stick around, and what do we do? So let's go to the next slide, and I think I've got one more slide here. Core deposit strategy, today versus, again, we build it, and then let's just go right to the next slide. It's readiness for tomorrow. How long are these deposits going to stick around, right? Are consumer behavior patterns going to repeat? Will competition be redefined? Right now, nobody's looking for funding. I can tell you the least cost of funds right now, if you need it, right, is through IntraFi by a wide margin. It's almost free. The question will become, when the cycle turns, what are we going to do? Are we willing to accept some deposit loss? Will we? At the margin, it's too expensive to try to retain all these deposits. I'm going to show you one more slide, which I think is would be helpful to you. If you look at where the yellow and the pink meet, that's when the COVID surge hit. If you look at that gray, those are the non-maturity deposits for this institution, and it's consistent across about 650 banks that we look at. Your normalized growth in your non-maturity deposits, if I just run that line straight out past and through the COVID surge, most of us have had about 30 to 40% COVID surge. We're worried about how long is it going to stick around. I'm going to show you three scenarios. Number one, if 25% of this surge runs out the door, right, through January of 22, and I add my normalized growth, we still have all that excess liquidity. If you hit the next button, Steve, it'll build, and then you might as well just hit it a couple times, build the whole slide. Scenario two, run 100% off, and scenario three, run 50%. What we find is we're probably, our data scientists assume that it's probably realistic to assume about a 25% runoff. And if you look at that green line up above, that's kind of where you end up at the end of 2022 with 25% runoff and your normalized deposit growth. Why is that important? Even if 100% ran off, still net, you'd have the same level of deposits at the end of 2022 that you had pre-COVID. So this should give you the intestinal fortitude to take some of that cash that's sitting around burning a hole in your pocket, make loans, invest it, get it out on the curve. Right? Those are all interest rate risk related issues, not a liquidity issue. So don't be too concerned about deposits running out the door. Our estimates are it's going to continue to grow, and even as it starts to dissipate, you're still going to have excess deposits 12 to 18 months moving forward. If you were to go to the next slide, right? How do we predict deposit growth and pricing? When does it make sense to raise rates to mitigate some of that decay? How much confidence do we have in terms of lagging rates as we move forward? Do we introduce new products? What's our pricing strategy? Everything should be viewed from the perspective of lower marginal costs. When we move forward, we can't hold every last dollar deposit that's in the bank. Some of it will move out and go to the least cost of funds. And again, there's so many products available to you through IntraFi that you ought to consider. And then inflection points. If and when the Fed starts to move interest rates, there's a tendency for banks to lag. The first 25, the first 50, and then the next 100. So if we don't see that 100 basis point increase in rates until 2023 or 2024, the reality is you're going to be able to lag pretty significantly moving forward. And that's important to understand, right? I'm going to show you one last thing. If you hit that build slide, if I were to ask you, what are the, and you can build that, Steve. I surprised you guys at the last minute with a couple of these slides, but if I were to ask you, how are short-term non-maturity deposit rates and even money market rates, how are those priced off of? Short end of the curve or long end of the curve? You say the short end of the curve. And historically, that's been relatively accurate until all of a sudden, even though short rates are 25 basis points, long rates this cycle came down much farther than where they were last cycle, putting more pressure on margins. There's more competition right now, in which case, to get back to where we were, to maintain that same spread between long rates and non-maturity deposit rates should really be negative. Now, we're not going to go negative, but there's still room for many of us to lower our non-maturity deposit rates. Take a closer look at that, and don't be worried about money leaving the institution. It won't. I promise you it won't. Of all the banks we work with, some are almost at zero. It's not leaving. And don't look at average cost of funds, because your average cost of funds is a blend of all of your zero costing DDA and checking accounts. Look at the independent individual accounts. So that's that's kind of the precursor to the next slide, which basically suggests that when it comes to liquidity management, how you measure liquidity, how you manage liquidity, your policies for accessing alternative funding sources, the way you view wholesale funding impacts everything that you do. Whether you're willing to put the money out on the curve on the loan side, how you price deposits, whether you sit in cash or you get the money out on the curve, how you grow moving forward. If you think about that institution that I showed you earlier on, they had, their policies give them the flexibility to access the wholesale markets to a much greater degree than the average institution. So if and when you want to continue to grow and liquidity is a little bit more challenging, utilize the wholesale funds. At the end of the day, all it is a raw material that goes into the end product where you have all the control. And all these things ultimately have a large impact on bottom line earnings. So that's the end of my session, and I'm excited to hear what you folks have to say.
Thank you very much. Thank you very much, Frank. This little cartoon, you can read the caption, being psychic is hard, but I knew it would be hard. So we can't predict the future. And as I'm listening to you, Frank, I'm thinking of that Back to the Future comment that was on one of your slides, and how often we talk to bankers and say, I wished I had done that strategy a year ago, 6 months ago. And you just have to go back to one of your slides to show that financial crisis. And where a lot of opportunities sat, and a lot of folks let it pass by. But hopefully today we can inspire a few of you guys to take advantage of some of these opportunities. Danny, let's go to the next slide. One more. So what can you do? We've got 5 strategies that we see banks deploying today. We're going to have Frank to comment on some of these, but so what can you do today? So Danny's going to cover the first 4, and I'm going to cover the 5th one. We're going to talk about helping customers defend against uncertainty, talk about growing core deposits, replacing collateralized deposits, again, creating asset liquidity for your balance sheet, enhancing your bank's brand, and then diversifying wholesale funding choices, which Frank has touched on a couple of times. So Danny, why don't you take it away from here?
Thanks so much, Steve. Thank you, Frank. This is great information. And the opportunity one that Steve talked about is just defending against economic uncertainty. The flight to safety for your customers is significant. We've seen it. We've witnessed it in all of our banks. It continues to astound us as how much deposits are sitting on balance sheets in the country. Though some of these new customers might withdraw funds, they represent customers that are sticky, that you can maintain, that you can build upon, and you can cross-sell. And the biggest piece for me in my career is cross-sell, because cross-sell equals retention and profitability. I will tell you the reason why most of these customers are moving into an FDIC insured product is because they're thinking about safety first, liquidity second, and yield third, to go back to what Frank was talking about. So return of their principal rather than return on their principal is the key thought process behind every single one of these customers that are using the flight to safety and FDIC insurance. So if we talk about how we can give FDIC insurance to your customers through InterFi Network, your bank can provide customers with return and access to their funds. What happens is the customer comes to you, they make a large deposit. That deposit is going to be broken up into destination institutions through our technological advancement, and that will be remaining until the customer makes a withdrawal. And it'll be principal and interest that's covered, and the franchise value of those deposits are incredible for the bank. And we'll talk a little bit about the opportunity associated with that. How can your bank muster up the yield associated with these deposits, like Frank was talking about, making loans, buying securities? What are we going to do to build the future for your financial institution in this particular environment? And so if we kind of think about these deposits and why we think they're so sticky, well, 80% of the CD balances reinvest. Less than 3% of the money market and DDA balances actually liquidate. So when you think about the deposits on the right side of the screen here, you're dealing with customers that are sticky, that are going to stick with you. And even as rates do rise, Frank mentioned this, you can lag the rising rate environment and generate more net interest margin. And that's really critical when we're thinking about next steps. And so if we talk about something that changed, that should be something that you're thinking about in your deposit retention and acquisition strategy committees, is talk about growing reciprocal deposits. Reciprocal deposits came into being and became non-broker deposits in 2018. That means up to $5 billion on your balance sheet, or 20% of your liabilities, can be considered non-brokered, and they're actually reported as core deposits. Since they tend to be lower cost, they generate more NIM for the bank, net interest margin, but more importantly, they create franchise value. And InterFi Network invented reciprocal deposits, and today we're the #1 provider of that service. And so if we think about what that franchise value means, approximately 20% premium that you're going to generate off of core deposits, or $20 for every $100 of core deposits that you carry. So thinking about these types of deposits, they're going to generate profitability for your organization should you be in an acquisitive mode. And for every $100, you're going to generate $20. That's incredible growth in net interest, in profitability. So as we keep going, the other thing that we talked about is cleaning up the balance sheet, replacing collateralized deposits. By replacing collateralized deposits with deposits eligible for FDIC insurance, your bank can replace higher cost funding and improve asset liquidity. You can also generate an additional revenue by repurposing those funds. We go back to what Frank was saying, buying securities, leveraging loans, taking advantage of that, reducing your collateral tracking burden and your customers' tracking burden that they have, and then lower the risk of shortfalls due to collateral value deterioration. I can only say this, that I've had 50 to 100 calls over the past month and a half where banks are trying to move away from direct pledging or pledging altogether and move into an FDIC position because they feel like standing that up today prepares them for the future. And that's really a bank that's looking down the road and thinking through how they're going to be able to manage through the next stage of their existence with the rates going up. And so if we think about when you free up those deposits, what kind of yield can you generate? And this is just one example of where reciprocal deposit solutions can allow you to, let's say, free up collateral pledged against $20 million in deposits. So let's say this financial institution has 2.99% yield. The securities that they're buying is 75 basis points. Illustratively, we can actually increase that by moving more of those deposits or those collateral pledged into a loan or into an instrument that's earning better. And net income in this example is $338,000. That is extremely positive for your institution. That generates NIM that will carry you forward and help maintain the situation that we've got going on right now with the excess and liquidity and deposits that are sitting on your balance sheet. The other thing that has happened is we saw that the bigger banks prior to the pandemic and even through the pandemic, or the online banking community, actually did a fantastic job of raising the rates, acquiring your customers, moving them away from the community bank. And now there's a pause because rates have come down. There's not really much opportunity for some of these online banks to pay up for those deposits. So this is an opportunity for you to really enhance your brand, work with your local customer. You still have the value that is distributed throughout your market and your footprint, and that is personalized service, where they can touch and feel their banker. They now can use the online services, but they can use it with your bank. And that's really powerful and puts you really in the driver's seat, and that enhances your brand. And we actually polled 17 different end customers, customers that work through banks of ours with the permission of the banks. We actually talked to the end customer, and what they shared with us was that IntraFi Network Deposits provides a clear reporting and ability, enables businesses to get seamless protection while not having to manage multiple accounts, meaning they didn't have to get in the car, go from bank to bank to bank and deposit $250,000. They could simply go to one bank, deposit their $5 million, and that would be distributed from bank to bank to bank, creating FDIC insurance for principal and interest. But if they did go to banks, different banks for $250,000 a clip, they would get blended interest. They would have to do Know Your Customer regulatory compliance, Bank Secrecy Act compliance. They would also have to sign all the documents at all those banks and aggregate that at the end of the day, which is just a time drain for your customers. It is something that some of your customers are doing. They may park some money with you, but because they want FDIC insurance, or their centers of influence, their accountants, their lawyers, told them to spread it out, not keep it all in one bank. Well, now you have an opportunity to bring that money back and keep it at your bank and use it to generate those loans and buy those securities that Frank was talking about, enhancing your position out there, enhancing your net interest margin. I like this slide because it kind of tells us what we can do if we develop, like an ALCO, a deposit retention and acquisition committee. We can actually identify with your relationship managers where to go to get these deposits. Commercial customers, we've seen the growth of commercial customers in the network exceedingly positive. It's actually eclipsed the public deposits that we have in the network, and that's because the flight to safety. The corporate customers have realized that they can get access to FDIC insurance at your bank. You can cross-sell them treasury services, and it enables you to manage that relationship going forward, really wrapping your arms around them, keeping them, investing in them investing in you, and you growing that relationship for franchise value. Of course, government entities, we've talked about that. Nonprofits. There is another group that's out there. That's the community association managers and the property managers. What IntraFi has done is we created a CPA, CPE seminar that you can give an hour's worth of credit to those centers of influence. We just rolled out a community association manager CE credit that could actually enable you to go after property managers, associations, homeowners, and homeowners associations, and really gather those customers up, give them an hour's worth of credit. But that's an untapped market that I think a lot of banks have really started to focus on because of the different treasury services that these customers require. And then the other larger deposits, of course, there's 1031 exchanges. I'm actually meeting with a client tomorrow where we're creating a marketing campaign for the bank where they're going to have a customer who just sold their business, took a minority ownership in their business from a majority stake, and has $100 million to deposit at that financial institution. We're going to talk about using the MMDA and the DDA so that the bank could actually keep their entire relationship cross-selling treasury services. This happens to be a very good customer of this bank, and what the bank relationship manager told me is he does not want to lose this customer. And then finally, before I turn it back over to Steve, we can talk about really managing your bank's brand by appealing to your public funds customers. 50 out of 50 states have approved the money market and the DDA for the purposes of public funds. That means that most state laws require collateral or FDIC insurance. And without IntraFi Network, you would not be able to give customers access to FDIC insurance for more than $250,000. We can take up to $150 million per tax ID in a money market and a DDA. So tracking collateral value for you and your customers is going to go away with this solution. In addition to that, you're going to be able to repurpose those funds for more profitable opportunities. I haven't had any questions come up, but we'll have time at the end. I'm going to turn it back over to you, Steve, to talk about funding.
Thank you very much, Danny. Diversified funding and fine-tuning contingency plans. No better time, as Frank said. Let's tear apart our policies. Let's take a good look at where we're at and the things that we're doing within the bank. We know you're sitting on a lot of liquidity, but what a better time to think about, okay, where do we want to be in the future? And we don't know how quick this funding is going to roll off. Something it could be very quickly. We had a couple of scenarios previously. But forward-thinking bankers are certainly starting to look about taking advantage of this low-cost term funding. We've got a number of banks that have taken out 5-year money right now. They know they can make a couple of bucks today, but down the road, the market starts to move, rates start to move up, and they'll look like heroes. So we do see some banks that are reaching out, and you certainly have a lot of opportunity to swap, floating to fixed and so on and so forth. On the next slide, a little bit about us and our funding. We are the largest private wholesale funder in the country. We have wholesale funding solutions that offer scale and speed. That'd be a great tool for you. If we're not part of your contingency plan, I suggest we should be part of your contingency plan. Come in and test us out, and we'd love to earn your business. But we can also tailor structures that works exactly for you. We've created different speed pools for banks with different portfolios. We've done lots of very, very creative funding techniques that will help you in a great way. We can be that one-stop shop for all your funding needs. And as you well know, you need as many funding sources as possible. And we'd certainly like to be one of those. A little bit from a comparative perspective on the next slide. I won't dig into this real deep, but on the left are all the traditional sources of funding that you have. On the right is us. Basically, at the bottom line, we count as a deposit, not a borrowing. There's no collateral. There's no stock purchases. We can do it in fixed or floating. We can help you swap it. We can do lots of different creative structures. So give us a shot. Danny, on the next slide, I keep thinking back, Frank, to move to the next slide, Danny, if you would. I keep thinking back, Frank, to that Back to the Future logo you had. And none of us have that DeLorean that Doc Brown had, right? That we don't have the ability to, 6 months from now, a year from now, I wish we could pop in that DeLorean, go back and then make those decisions that we wished we'd made today. But there is opportunities, right? We're not fortune tellers. We're not Doc Brown. But Frank, I'd love to get some more color from you on where you think those opportunities lie. And an awful lot's been put out here in the last few minutes.
Sure. You know what, Steve? I remember 20 years ago when Gene Ludwig approached us to talk about this product that was going to be introduced. And, we thought it was terrific to be able to introduce to our clients new product that nobody knows about. right? Now everybody knows about it. So when I walk through the door now with a prospective client or with new clients, it's like, this isn't new, Frank. This has been around for a long time, and everybody knows about this stuff now. I think you guys surpassed the federal home loan bank system. But you mentioned something about contingency funding. I look at this as partly contingency, but also partly operating liquidity. And so when interest rates change after the pandemic hit and credit spreads widened, we had clients that would pay. We paid down brokered, we paid down FHLB, all through IntraFi at significantly lower costs, and I mean 45 to 55 basis points cheaper funding. And for a lot of those same institutions, we had to modify our policies because their policies didn't allow them, to take down as much funding through some of these sources as they had originally put into their policies as contingency funding. And at the end of the day, whether it's a borrowing, a deposit, funding through, IntraFi, at the end of the day, it's all raw materials that give you more control and how you manage. And so I would encourage everybody that doesn't have access or doesn't use it, to use it. We're in an environment right now where margins are under pressure and they're going to continue to come under pressure. We say that, 2021, that's in the bag. Most of our clients, most of you probably have had record years. 2022 and 2023, those are going to be the challenging years because every dollar of cash flow that comes in off the loan portfolio, the investment portfolio, are being lent out or invested at lower rates. So margins are going to continue to come under pressure. And for a lot of us, what we're going to need to do is hold on to absolutely every single loan that we can get our hands on. Don't lose your best credits for 25 basis points. Some of us would, we dug our heels in the ground at 375 and we lost the deal. Did it really make a difference, 350 or 375? What's the alternative? To sit in cash? Get the cash out there. Get out on the curve. Build your loan portfolio. You've got plenty of access to liquidity down the road if and when you need it. And so, again, having access to all of these different tools is going to make a big difference. And you're really going to have to make up in volume what you're losing in spread in the near term. If rates continue to stay as low as they are, have the intestinal fortitude to drop some of those non-maturity deposit rates a little bit lower. Think about what every basis point means on your non-maturity deposit base in terms of income, right? So anything else, Steve, that you want to address, whether it's loan pricing, deposit pricing?
That's a good question, Frank. Why don't we open it up, Naomi, to the attendees? Got quite a few folks on the line. Let's see what kind of questions they have to make sure we're answering specific questions.
Perfect.
Yes. I want to remind everyone that there's a chat box on your screen, and you can ask questions of our presenters there, and I will relay them. This may be more of a question for Frank. I was curious about it because we just wrote a story for the upcoming magazine about PPP customers. We have a huge amount of PPP customers now, and what are you seeing in terms of what banks are doing to retain some of these customers and turn them into regular customers for the bank?
Well, I can tell you that for a lot of the community banks, it was a perfect opportunity to build, more brand awareness and pick up customers that when they went to the very large banks, right, they didn't get handled with the same level of attention that they do at the community banks. And the community banks that we work with said we have built so many relationships because of the PPP. So that's one of them. Having access to, all of the things that you folks offer in terms of being able to accommodate them from an insured limit. If you look at all of the deposits that came in since COVID and you broke it down, you get under the hood and said, where'd all this money come from? I think what you'd find is probably 70 to 85% of those dollars are in balances that are above $250,000. And that's very important, especially when people are concerned about the safety and the return of their funding. So once again, being able to accommodate them in every way that you can to make sure that they feel safe in terms of doing business. And then, just reminding, you have to remind these small businesses of the value added that your bank brings to the table that they don't necessarily, think about or aren't aware of. And so to the degree that, you can cross-sell, as Steve talked about earlier, and provide them with all the things that the large banks have been providing them for years at probably better prices with better service, I think it's going to go a long way to retain a lot of those same customers. I think you'd really have to make some silly mistakes right now to lose those same customers that came in through PPP. And at some point, they're going to need loans and have some flexibility on the loan side. You know what? Revisit those policies once again. I know that 10 years seems like a forever for some banks and some bank directors. We don't do 10-year fixed rate deals. Well, why not? What difference does it make if it's 5, 7, or 10? Use the slope of the curve. That's the other thing. You may find that if the slope of the curve is steep, somebody wants a 10-year loan, they might be willing to go 7.5 or 8. Have some flexibility to accommodate what they're looking for. So I think it's all upside. That's probably one of the good things that came out of this whole COVID situation for a lot of the community banks is they grew their small business tremendously, and I think you'll hand on to most of them.
Are there tiers?
Sorry, Naomi. Frank, I had a banker recently say that he considers himself, if you use a fast food analogy, they're the Chick-fil-A. Community banks have, through all this events, are that Chick-fil-A high touch, high service model.
Absolutely.
Yeah. Are there tiered pricing strategies that you consider best practices?
One of the things that I ask bankers is, when was the last time you revisited your tiers? And they all look around at each other, right? I can't remember the last time we changed those tiers. So it's probably a pretty good time to start to revisit those tiers because it does make a difference. And then digging down into the deposit base through analytics can make a big difference in terms of how you strategize moving forward, how you price. So it's high time to revisit those tiers. You know what? $10,000 today is a lot different than it was 30 years ago, and yet some of us haven't changed those tiers. And 10,000 in a low rate environment is very different than 10,000 in a higher rate environment. So I think it's important to revisit those. And the other thing too is introducing new products if and when rates start to move up, as opposed to upsetting the existing accounts. Introduce new products, maybe a little bit higher rate, lag the other ones. And I think what you're going to find is probably 80% of the deposits stay in the old account, and to save the other 20% from leaving, you introduce that new product. We've had clients that have done that for 30 years, very, very successfully. It works.
Great advice.
Yep. And this may be more of a question for IntraFi. How do I determine if IntraFi deposits are approved for use by public funds in my state?
Steve, I'll take that one. We do have where to find either insured cash sweep or money market or DDA or CDs out on intrafi.com, and you can actually look up the public deposit statute for each state. In addition to that, you can just simply call the office or call your managing director, and they can walk you through it and provide you with marketing material to give to your municipality. It actually has the sales sheet on one side, the state statute on the other. And so that's really valuable. I just did that this morning for one of our banks in Florida. They called and asked if they could get the public fund statute for a customer that they're actually working with right now to secure their deposits. Instead of pledging collateral, they're going to put them into the MMDA product.
Go ahead.
Naomi, the IntraFi's network deposits are approved in all 50 states on a reciprocal basis for our services. That was either by law or by bylaw, but we got it passed in all 50 states.
What documents do your customers have to show their auditors that they have FDIC insurance?
So we provide the statements. There are monthly statements that the customer can actually provide their auditors to demonstrate that they've got access to FDIC insurance. And then through Bank of New York Mellon, their auditors can actually do a audit test and confirm that the funds are indeed insured. So a couple different stopgaps. We also provide 24/7 a depositor control panel where the customer can log in, look at their deposits, and know their number of transactions, their interest earned, where their deposits are for insurance purposes, and demonstrate that to the auditors, even give the auditors access to their depositor control panel. So there's a lot of ways that the end customer, the bank's customer, can demonstrate to their auditors that they've got access to FDIC insurance.
Okay. So as a reminder to everyone on this call, you'll receive the recorded version of this webinar within 24 hours. We will also post this on bankdirector.com. And I want to thank Frank, Danny, and Steve and the IntraFi Network for hosting today's webinar. And thank you for joining us today. Have a great rest of your day.
Take care, everyone.
Thank you.
Thank you, everybody.